Welcome to Section 7 of the ASC 225 Income Statement Training Series. Earnings per share, EPS, is one of the most visible and most litigated numbers in financial reporting. It sits right on the face of the income statement. It drives stock prices, and it is scrutinized by investors and regulators alike. In this section, we break down exactly how it is calculated, what can go wrong, and what you are required to show. By the end of this section, you will be able to identify which entities must present EPS on the face of their income statement. You will be able to calculate basic EPS correctly, including the often mishandled preferred dividend adjustment. You will understand how diluted EPS accounts for options, warrants, and convertible securities. You will know what makes a security antidilutive and how to disclose it. And you will know exactly what must appear on the face versus in the notes. Most people assume EPS is something only large companies worry about. Here is the key thing. ASC 260 requires EPS on the face of the income statement for any public entity, and for any entity that has issued or is in the process of issuing common stock. Non-public entities may elect to omit it, but that election must be conscious and documented. And once you are presenting EPS, it has to be on the face of the statement. You cannot simply tuck it into the notes. Every period, team lead performs a separate independent recalculation before the statements are issued. The basic EPS formula looks straightforward. Divide net income by weighted average common shares. But the numerator is where people trip up. You do not use total net income. You use net income attributable to common shareholders. That means subtracting preferred dividends. For cumulative preferred stock, you deduct the dividend whether or not it was actually declared this period. For non-cumulative preferred, you only deduct it if it was declared. And if there are non-controlling interests, their share of income is excluded. Basic EPS belongs to the parent's common shareholders. The denominator is the weighted average number of common shares outstanding during the period. If a company issues new shares halfway through the year, those shares only count for half the year. The math is a day-by-day or month-by-month weighting. Watch out for stock splits and stock dividends. These are applied retroactively to all prior periods presented, so that comparisons remain meaningful. Basic EPS uses only actual shares outstanding. No adjustment for options, warrants, or convertibles. That is diluted EPS. Diluted EPS answers a question every shareholder is asking. What would my share of earnings look like if every option holder, every convertible bond holder, and every convertible preferred shareholder converted their securities into common stock today? If that conversion would reduce EPS, the security is dilutive and must be included. If it would actually increase EPS, making things look better than they are, it is antidilutive and must be excluded. Antidilutive shares must still be disclosed in the notes, even though they are excluded from the calculation. For stock options and warrants, the treasury stock method is the required approach. Here is how it works. Assume all in-the-money options are exercised. The company receives the exercise price as proceeds. It uses those proceeds to repurchase shares at the average market price during the period. The net additional shares, the ones assumed issued minus the ones repurchased, are added to the denominator. Options that are out of the money have an exercise price higher than the market price. If you include them, they would actually increase EPS by repurchasing more shares than were issued. That is antidilutive. Exclude them. For convertible debt and convertible preferred stock, the if-converted method applies. The logic is, assume the holders converted at the start of the period. For convertible bonds, conversion means no more interest payments, so you add back the after-tax interest expense to the numerator and add the shares that would have been issued to the denominator. For convertible preferred, you add back the preferred dividends that would no longer apply, and again, add the conversion shares to the denominator. You only include a convertible security if its inclusion decreases EPS. Otherwise, it is antidilutive and excluded. What must actually appear on the face of the income statement? At minimum, basic and diluted EPS for income from continuing operations, and basic and diluted EPS for net income. If there are discontinued operations, EPS for discontinued operations must also be shown, though it is typically derived as the difference between net income EPS and continuing operations EPS. All of this must appear for every comparative period presented. And if there has been a stock split or reverse split since the prior period EPS must be retroactively adjusted so the comparison remains meaningful. The notes to the financial statements need to support what is on the face. The reconciliation of numerators and denominators from basic to diluted EPS tells users exactly how you got from one number to the other. Antidilutive shares excluded from the diluted calculation must be disclosed, how many and what type. In practice, before any EPS disclosure goes out, Team Lead performs a completely independent recalculation using the cap table and debt agreements directly. Errors in EPS are public and immediate. This is one of those controls you do not skip. Let us lock in the key points from this section. EPS is required on the face of the income statement for public entities and entities issuing common stock. Basic EPS divides net income, after preferred dividends, by weighted average common shares. Diluted EPS brings in dilutive securities using the treasury stock method for options and the if-converted method for convertibles. Antidilutive securities are excluded from the calculation but disclosed. An EPS must be shown for continuing operations, discontinued operations if applicable, and net income for every comparative period presented. Next, we look at the items that live below net income, other comprehensive income. Thank you for completing this section on earnings per share.